President Biden's drop in popularity posing a significant challenge for Democrats in the midterms. Our next guest, though, has some advice for the president. We want to bring in former New York City Mayor Bill de Blasio. Mayor, it's great to see you. Thanks so much for joining us today.
Thank you, Shauna.
You recently penned an op-ed in The Atlantic. It was titled, "Joe Biden Can, quote, learn from my mistakes." What's your advice for the president?
Yeah, I want to pick up on what Rick said a moment ago. You know, Shauna, I think there is time to turn it around. And I think there is more sense among Democrats the need to get something done, both moderates and progressives. My advice to the president is to recognize that you can't live in the weeds, which is something I did too often. You can't just do great work behind the scenes. It's really important to show people your work and to provide a unified message. And I think that's what's lacking right now. I think he's working really hard. I think he's actually quite a good communicator. But I'll give you an example. I mean, today he talked about affordable internet. That's great. A few days ago, it was semiconductors. That's great. Before that, it was Javelin missiles for Ukraine. But what I don't see is him saying to people squarely, here's how I'll bring down your costs. And that's what I'm going to focus on because I understand you. And I think there's time to do that, particularly on healthcare costs.
So then in terms of issues that could then make or break what happens in the midterms, but obviously a lot of people are going to want the support of the president as they're running for the midterms. What do you think are going to be the make or break topics for voters?
Well, I think the president is sitting right now on top of two extraordinary issues, to his credit, where he has put forward a lot of the right ideas and can turn them into action in time. I'll say it bluntly, some people will love it, some people won't. But one thing that is extremely popular in this country across partisan lines is higher taxes on corporations and the wealthy. That's a plan the president's put forward that actually could get out of the US Senate and pass. Equally, lowering prescription drug costs, something people feel very deeply. Another area where we've seen agreement from Senator Manchin, for example, and there's a possibility of getting something done. What I would say is it doesn't take everything. It doesn't take the president achieving everything overnight or on all fronts. What's necessary is some forward motion on the things that people feel viscerally. They certainly feel health costs very personally. It's a kitchen table issue. They feel the fairness issue around taxation very deeply. I think you add that together with some of the very good things the president's done, like infrastructure, and then a sharp contrast with Republicans on issues like abortion. And you're talking about a very different electoral reality 6 months from now than what we're seeing today.
Abortion may be the one unifying moment that this party has. Talking about the split, though, many focus, Mr. Mayor, on Joe Manchin, but right here in New York might be the best example of the split within the party between Alexandria Ocasio-Cortez and your predecessor, or the man who replaced you, Eric Adams. And the New York Times has a piece today saying they haven't talked in a year, and it characterizes it this way: Mr. Adams as an avatar of pragmatic moderatism, and AOC as an ardent left-wing warrior. Which of those two has the correct path forward for the party?
Well, I think you and I would agree pragmatic monetarism doesn't exactly roll off the tongue.
No.
So I wouldn't advise that as a slogan, you know. But look, I think the fact is, it's a really interesting article you're referencing from today about apparently, you know, a disconnect between the two of them. But here's what's interesting to me. There's a lot of common ground that has not yet been tapped into. For example, in both of them focus on the issues of working people, and that's where the Democratic Party excels. This would be a part of my advice to Joe Biden, again, based on my own experience, my own mistakes, is get back to that essential message of connecting with working people in their lives. Joe Biden, again, very good communicator. Eric Adams is a great communicator, so is AOC. They have common ground there. I think what the Democratic Party needs to recognize is, you know, that it's a little cheesy, but it's true. There's a lot more that unifies us than divides us. But what we haven't been smart enough about is getting a couple of key victories on the board on manageable things. That's why I point to things like prescription drugs, which really matter to people. And just a sharp, clear message about being on the side of working people, an area where Republicans historically have faltered. The Republicans are falling into another trap now, which is actually more profound than what's happening to the Democrats. The Trump endorsements, and I will tell you, I think Trump will generally win with his endorsements, but unfortunately he tends to choose rather extremist candidates. When you put that together with the Roe v. Wade situation, I think it's going to be really tough for Republicans to win the votes of a lot of working class women and suburban middle class women. So there's time to pull these pieces together. And I'd say to my colleagues here in New York, sit down and talk, because I actually think you have a lot more in common than you realize.
Mayor, when we talk about the future of the Democratic Party, when we look beyond the midterms, the focus then is going to turn to the 2024 election. Speculation about whether or not we will see a Biden-Trump rematch. I'm curious just for your take, who you hope to see or who you think the Democrats should put forward in 2024.
Well, let's acknowledge that 2022, November, is 6 months away. That's a long time. 2024 elections are way, way off. But right now, it would be Joe Biden, because he has the different elements that add up to a victory. I mean, he won by 7 million votes and won states like Arizona and Georgia. That's extremely impressive. And again, I think some of it is he is a likable, relatable human being who can actually unify a lot of the party. His positions are very amenable to the progressive wing of the party on so many issues. I mentioned a few on prescription drugs, on taxation, but he also really relates well to the moderate wing of the party and to working people across all ethnicities. That's the winning formula for Democrats. So based on everything we know right now, the guy with the best chance of holding the White House in 2024 is Joe Biden, the guy who holds it right now.
And are there any voting blocks that you think the Democratic Party should perhaps focus on more or really encourage more to really get them on board with the midterm elections?
Oh, absolutely. I will tell you, I think in terms of the midterms, I'll state the obvious. Again, working class women and middle class women, I think, are going to look at this whole election differently because of what we heard last Monday night. I think that's going to be a voting issue, an emotional, intense personal issue that actually will motivate people to vote. And that means in a lot of the key swing districts in red and purple states in particular. That's one. But I also think Democrats still need to do better across all working class categories. So, you know, a lot of talk has gone into the white working class, but if you look at some of the recent polling, Democrats have to do a better job with Latino and Asian and African-American working class people. But I think it is about going back to our roots, really, with those core economic kitchen table issues. I think a lot of people are still listening. I think American voters have become more and more independent-minded, if you will. They think more independently. They're less connected just to party identification. But Democrats must give more of a clear rationale to those working class voters. I think a lot of them can be won back, and particularly I think that's true among women.
I want to ask you about what's going on here in New York, and the latest data shows 33% of workers in New York have returned to office, the lowest in the country, 10% lower than the other 10 major cities. And the highest, the polls are showing that people are actually more concerned about their safety, about crime rates, than they are actually about COVID in particular. Do you feel at all responsible for that crime and for people not feeling safe? And what's your advice to Eric Adams in solving that challenge?
Well, it can be solved and it will be solved. I have faith in Eric Adams, and I'll tell you why I'm so confident, because in the months even before the pandemic, just over 2 years ago, we had the lowest crime rates we had had since the 1950s. New York City was unquestionably the safest big city in America as recently as 2 years and a few months ago. So we know it can be done. We've gone through a very profound disruption. We were the epicenter of this crisis with COVID. There's been tremendous pain and dislocation. On top of that, remember, when you talk about people coming back to the office here, it's against that backdrop of so much fear still about what COVID did, so much that people experience that is different from so many other cities. This is a city where people commute on mass transit more than any other city in the country. And if they see some incidents in our subway, for example, of course, that's going to give a lot of people pause. But I think this is about being really persistent. The NYPD is the finest police force in the country, 35,000 officers strong. They will turn this situation. We got to do more to bring the communities and the police together. That's an area where there's still work to be done because of the rift caused very painfully during COVID and after the murder of George Floyd, and that doesn't heal overnight. So I am convinced that the tide will be turned, and I think it will happen in the course of this year. I don't think it'll be the next few months, but I think it will be during 2022. And what ultimately happens in New York City historically is the resiliency wins the day. People will come back. They will show faith in this city. You've seen incredible investments from the tech sector and the life sciences sector in just the last year. You've seen real estate prices booming. These are not accidental indicators. There actually is a lot of confidence, but it's going to take some more results on the ground to turn the corner.
Mayor, we want to ask you about a headline that's been getting some attention here in recent weeks. New York City Councilwoman Joanne Ariola saying that she wants your pension to be docked until the $320,000 spent on what she characterizes as misusing your security detail while in office until that is repaid. I'm curious, just what is your response to what she's calling for, the fact that she wants your pension to be docked?
Well, look, I think the bottom line here is if we believe in a fair system where you really try to get to the truth of the best way of doing things, then you should believe it's important that I raised very serious issues about the ruling she's addressing, issues that I think were problematic in terms of security for mayors and their families going forward, in terms of legal precedent, a number of issues that are still being considered by the appropriate authorities. And we need that process to be resolved. And that would be true with any issue. When someone offers an appeal and says, wait, I think there's more here that needs to be considered, that needs to be respected. When all is said and done, of course, I'm going to follow the law and want to always do things appropriately. But I think I haven't heard the details, but I think the council member is leaving a big piece of this puzzle out of the discussion.
All right, well, we'll see if we can get her response as well. Thank you, former New York City Mayor Bill de Blasio. Appreciate it, sir. Thanks.
Let's dive more into the company's business with Papa John's CEO, Rob Lynch. Rob, always great to get some time with you. We were just talking to Cleveland Fed President Loretta Mester, and she outlined the scenario where we might see another quarter of negative growth. From your vantage point, does it feel that challenging out there right now in consumer land?
So, Brian, thanks for having me on. You know, what I would tell you is it's almost a tale of two worlds here. We've got great demand for our products, positive comps in Q1, despite the most challenging operating environment we've ever seen. And we just guided for positive for the year. So we're bullish on continuing to grow. That being said, you know, there's a lot of opportunities for us to get even better. The labor model is still challenging, both from a wage inflation and a staffing standpoint. And obviously, we've got the commodity inflation that everyone is seeing. We've been able to strike a good balance between productivity and pricing to be able to mitigate some of the impact of that inflation. But it's still a challenging operating environment where, I've got to give credit to our franchisees and our team members who have been able to persevere through, really what's been about 2 years of, a new normal seems like every quarter. So, but we're bullish on 2022. And we think, if this inflation does come under control, some of the things we've done during the last 4 to 6 months will actually put us in an even better position coming out of this situation.
Rob, when you and your team go line by line on the income statement, do you see any signs that inflation is peaking in transportation, in ingredients, in wages? Do you see anything in there?
We do see some improvement, at least a plateau on some of the inflation on both the food cost, as well as maybe some of the wage inflation starting to normalize. I wouldn't say it's going down yet, but staffing levels have sequentially improved throughout the year. January was by far the toughest month for us. I think, people forget the word Omicron at this point, but it posed one of the toughest operating environments ever, where we had 5 or 6 team members per restaurant out at any given time. And so really hard to operate in that environment. But now, since then, we have seen staffing levels improve, and that should mitigate some of the wage inflation that we have seen, for the last really 18 months.
Hey, Rob, it's Julie here. You talked a lot on the call about you guys being an affordable option for people, or, providing a sort of a range of prices for people so that they can afford it in this environment. But in this environment, is something like a plain pizza a loss leader for you guys? Are you losing money on the lowest price items on your menu?
There's definitely been some margin dilution, but we're not at the point yet where we're seeing, negative impact from our core sales. Obviously, if there's a really hot promotion done at a local level to try and drive some incremental transactions, that could be kind of at the break-even level, but we're still making money. And what we've done over the last 2.5 years is we've launched a lot of premium innovation at premium price points that have allowed customers to self-select into those items, like Epic Pepperoni Stuffed Crust we just launched 2 weeks ago. So we have a bit of a barbell strategy, to your point, where we still offer, an $8 large pizza carryout, but we're promoting our Epic Pepperoni at $14, which is actually the highest national promoted price point we've ever had.
Rob, in the first quarter, you took, 7% pricing. Is that the new norm going forward here?
Well, Brian, I sure hope not. We are trying to be very careful about how we think about pricing. We've built a great revenue management capability here at Papa John's over the last 2 years. As you know, we have more data than pretty much anybody in the industry, because 75% of our business is e-commerce. So we're able to really understand the price sensitivity of our customers, both at the national level, at the local level, even at the store level. So we're trying to be very surgical about how we approach our pricing strategy. Our 25 million loyalty members allow us to target each of our customers almost on an individual level with the amount of incentive that they need to incent them to purchase.
Speaking of incentive, Rob, and I have to tip my hat to you because you have made a lot of changes at Papa John's since you arrived, but you are now tying, part of your compensation and the team's compensation to certain ESG goals on diversity, inclusion. Talk to us a little about what you're doing there and what are some of the goals specifically?
Our core values and our company purpose have been at the heart of everything that we've done throughout the pandemic. And I fundamentally believe that that's been one of the reasons why we've delivered 10 straight quarters of outperformance. And moving forward, looking ahead, we continue to challenge ourselves on how we can get better. We've always been the better ingredients, better pizza company. We also want to be the better ingredients, better pizza, better planet company. That means a lot to our employees. It means a lot to our customers. Personally, it means a lot to me. So we have, kind of thrown down the gauntlet and said, look, we're going to put our money where our mouth is, and we're going to focus on the things that are not only important to the financials, but are important to all of our constituents in making the world a better place. So it's part of my compensation. It's part of my executive team's compensation that we do good while we obviously move the company forward.
All right, we'll leave it there. Papa John's CEO Rob Lynch, always good to see you. We'll talk to you soon.
Student loan debt. It's become one of the biggest political issues of our time. How big? 46 million Americans owe an astounding $1.75 trillion. President Biden has pledged to do his part, attempting to fulfill a campaign pledge of $10,000 of forgiveness. Grey's Anatomy star Jesse Williams is not waiting on the government. He's forging his own path together with Scholly, pledging to pay off $25,000 in student debt. Jesse joins us now with Scholly CEO Christopher Gray. That is Gray, no relation to Meredith Grey. Jesse, tell us about Pay It Off. And there's so many ways to give back. Why is this personal for you?
Well played on the Gray. Thanks for having me. Thanks for having us. My payoff program is actually $100,000. We're offering $25,000 to 4 individuals to pay off their student loan debt. And we have been, as an organization, Scholly, fully committed to keeping students in school, giving them as much access as possible to the wide array of scholarships available at their disposal that they might not have been aware of. We've connected students to over $110 million in scholarships already. And we also catch them on the other end. We know we have a predictable issue of paying off those student loans, paying off debt that students are saddled with just for trying to stay in school. So we're really engaged at all fronts on this issue around education, affordable education, especially for working families, particularly students of color are hardest hit and otherwise disenfranchised folks in this country. So we're really proud of the innovative work we're doing and utilizing technology to help us do that.
All right, Christopher, tell us how it works. How can people get started? I know the deadline is coming up.
Yeah, so right now, the current deadline for the student loan payoff is May 31st. So you just go to myscholly.com and go to our exclusive and you'll be able to apply. It takes 2 minutes to apply for the first round. So it's really, really simple. So we want to make sure that we get get it in the hands of as many college graduates and students as possible.
And Jesse, why is this personal to you? Why did you pick this cause to get involved?
A few reasons. It's personal to me because I bounced around from many different school programs as a young person, not being able to afford access to a quality education for some time. I've had the benefit of scholarships. I've struggled through college as well as my classmates and good friends did for some time, semester to semester, not knowing and working on a real budget, having to take extra work study and ROTC and all these things to not know if I'm going to be $5,000 short for next semester. And I saw many of my good friends be forced to drop out because they could not afford to stay in school. And it's completely unfair. And you watch good people be stripped of an opportunity at 19 years old. They have nothing to do with their family's income, their generational wealth, their parents' connections, laws and legislation. We have nothing to do with it, yet we are the ones that get kicked out of school for something that has nothing to do with us. So it always stuck with me as a public school teacher later in life. Once I finished college, I was an educator. And, I watched students just like me, young, trying to figure it out, wanting to be afforded the patience and opportunity to try things and make mistakes and try something else and have somewhere to fall back to while you figure out what you think you might do with your life. And how you could possibly know that at 19 and 20 is a different question altogether. So this is a very passionate project for us both. This came from, Chris living this life and figuring out how to find scholarship money for himself as a young person. So we feel really strongly about it and proud of the product, and our consumers are responding.
Chris, are you satisfied with what the federal government is doing, with the intentions of President Biden? And is there something larger that needs to be fixed? It's one thing to pay off some of these students' debt, but is there a system that needs to be fixed?
Yes, I think that it really starts with the cost of college. College costs rise every year because they're incentivized to do so because they know that students can just take on more and more student debt. So I do think the federal government, they should try to do something to really help curb college costs. I know there are talks around forgiving student debt at like $10,000, $50,000. There's different times across the board, but it definitely requires, I think, the government to get involved. So I really look forward to hearing what the Biden administration is going to do something. Apparently, I think they're going to announce something in a few weeks, but we definitely need involvement, but because it means student debt starts with the cost of college. So I think making college free, more scholarships, more grants, the government giving larger Pell Grants. I think there are a number of things to really help students, especially first generation students and students of color who, as Jesse mentioned, are hit the hardest with the student debt crisis.
And Jesse, of course, it's your acting career that helps bring attention to this important issue in the country. I do want to ask you about that. Season 18 of Grey's wraps on May 26th, and Dr. Jackson Avery returns. This is a job that a lot of people are doing this in the pandemic, quitting a job and then returning to it. What brought you back, and how emotional is that experience? You spent 12 years there.
Yeah. Yes, I'm going to reappear for that final episode. It's also the 400th episode. So it's a real landmark for a historic show, and I'm showing my appreciation by making an appearance and reconnecting with old friends and coworkers. And it was lucky enough, we're on Broadway right now with Take Me Out, and I had one day off, so I was able to sneak back and give them a day of work, and it was really wonderful to do that for the fans while also being out here on stage.
You mentioned Take Me Out, and you received a Tony nomination for Best Performance for your work in that Broadway show. Congratulations. You said you needed to get out of your comfort zone. You certainly did that. How terrifying is that experience? You're up there, you're live, you see your audience, there is nudity involved. This is way, way out of your comfort zone. Is there something that we can all take from that experience of getting out from that comfort zone?
There is it did take some temerity there. It also, what it does remind me of is teaching. When I was a teacher, you're in front of a room, in front of a bunch of people that might not necessarily want to be there. You got to keep them entertained and engaged and inspired and come up with creative new ideas live on the fly, be able to be present and connect and feel the tone and space of the room. So there is a familiar skill set there which is something that connects directly to what inspired me so much about joining forces with Chris and Scholly, actually.
If you want to get on that 100K, it's myscolly.com/Jesse. Jesse Williams, Christopher Gray, appreciate you both. Thanks so much.
Carnival said earlier this month that its entire fleet is back in service. Joining us for more on Carnival is CEO Arnold Donald. Arnold, great to see you as always. Welcome. So all of these ships are back out there doing what they're supposed to be doing, bringing cruise goers on vacation. How crowded are these ships?
Brian, first of all, good to see you, and good morning to you. Look, we have on our Carnival brand, we have 9 World Cruise Line brands. On our Carnival brand, yes, all 23 ships are back. As of May 2nd, we have fantastic occupancy. People are having a great time. Carnival is doing, very, very well. Our other brands, we have over 75% of our total fleet back. But as you know, there are places in the world that still are not open yet. China is, of course, on lockdown. Australia is just beginning to open. We're excited. Canada finally opened up. Japan, there's limited opportunity at this point in time, but that's changing as well. So we're on the upswing, and guests are having a great time.
If I actually decide to take a vacation this summer, Arnold, am I going to get sticker shock if I try to take a cruise on a Carnival, just given this inflationary environment that we are on?
I don't think you're going to get sticker shock, but if you're asking the question, how is pricing? Generally speaking, pricing is stronger than what it was, say, back even in 2019 pre-COVID. But you're not going to see the same level of price increases that you've seen in some other sectors of the economy and some other sectors of travel and leisure. But pricing is at this point strong, and we expect it to continue to be.
Where have you been able to increase prices?
Basically, it's ticket pricing, but then also we include in our overall revenue results, of course, onboard spend. And that's just people, we make available to people things they want. And we try not to sell much, but just make sure we understand what they want and make it available. And so onboard spending is up significantly, but also in many cases, the pricing is up and it's on itineraries, generally across the board.
When the ships that are back in the water, what are you seeing from consumers in terms of onboard spending? Where are they spending? And is there any indication they are concerned about their own budgets?
Well, I think right now a lot of people are just happy to be traveling again and having the opportunity to have great vacation experiences on wonderful ships, in our Carnival line, Princess, Holland America, abroad, AIDA, P&O, Cunard, and Acosta. And of course, our ultra luxury Seabourn line. And people, so across the board, whether it's mass contemporary brands, ultra luxury brands, whether it's in spa, whether it's in excursions, whether it's in casino, whether it's in specialty dining, we see across the board increase in spend and retail as well. And I think a lot of that is just, people are glad to be out again and glad to be socializing and glad to be building the joyful memories that cruising is all about.
One of your competitors yesterday said on their earnings call, Arnold, that they're not going to go back to Russia until 2023 or 2024. Do you have that same commitment?
look, the commitment for us is, first, obviously, we're going to be in compliance. Our number one priority always is compliance, environmental protection, and health, safety, and well-being of everyone. In the case of Russia, yeah, we've replaced our St. Petersburg itineraries with destinations in Latvia and Finland and Sweden and other places. So, we'll see when the time is right to go back. I'm not trying to predict when that will be, but we certainly aren't going back in the near term.
Lastly, I think you surprised a lot of folks, Arnold, a couple weeks ago. Said you were semi-retiring, if you can call it that. Why did you decide now?
I think, first of all, I'll be moving to vice chair effective August 1st. I'm very excited about Josh Weinstein, who's going to assume the responsibilities of president and CEO. He's currently our chief operations officer. So very excited about the change. Why now? Things are pointing in the right direction. Obviously, who knows what choppiness lies ahead, but overall things are pointing in the right direction. We're on path to get the full fleet back up and sailing. We're on path to generate positive earnings, et cetera. And it's been 9 years in the role, and it's time for the next generation to be able to assume the helm. I'll be around as vice chairman. Our chairman, Mickey Harrison, will still be around, so we'll have continuity along with other members of our board who provide continuity. But it's time, and I feel it's a good time, for a smooth transition. And that's exactly what we're enjoying. It's a joy to work with Josh and the rest of the leadership team, and we're already having fun with it.
You do not get to lead a public company for 9 years if you're not doing things right. I imagine you learned a lot over the past 9 years. What is your biggest leadership lesson having led Carnival that past 9 years?
I'll tell you, I'm an older guy, so I had a lot of experience before I came into this role 9 years ago. But what was reaffirmed to me in this role is listen, listen, listen. If you listen to your guests, they'll tell you how to exceed their expectations. If you listen to your employees, they'll tell you how to deliver for those guests what they're looking for in a sustainable way. If you listen to the communities and the broader stakeholders, the shareholders, the media, et cetera, they'll tell you, what they're expecting of you as a good corporate citizen. And if you listen carefully and then you execute against what you're listening, what you're hearing, you will absolutely enjoy success. And despite all the challenges we've had, we've come through this really well. We've demonstrated resilience. We're on a path for an even brighter future for the corporation that existed pre-COVID.
I'll say this, you're one of the first guys that actually gave me an interview when I was first starting out in this crazy field, so I thank you for that, and good luck in your semi-retirement. Carnival Cruise Line CEO Arnold Donald, always good to see you. I'll talk to you soon.
Thank you, Brian. Be safe.
I am joined here live on Yahoo Finance in an exclusive conversation with St. Louis Fed President James Bullard. Obviously, the Federal Reserve very much in focus, so it's great to have you on the program this afternoon, President Bullard. How are you?
Very good. Thanks for having me.
So I want to kick things off with a conversation about the inflationary numbers that we got this morning from the Consumer Price Index, 8.3% on a year-over-year basis in April. What were your broad takeaways from that report?
Yeah, I don't think we want to emphasize one report too much, but my takeaway is that inflation is broader and more persistent than many have thought, and that the Fed will have to act in order to keep inflation under control. And we've got a plan in place, which is, 50 basis points at the last meeting, and teeing that up for future meetings as well. I do think we need to get to a higher level of the policy rate to control, especially the persistent part of the inflation process.
President Bullard, I had the luxury of speaking with your colleagues in Atlanta and also Cleveland yesterday, both of them saying before we got this inflationary print, to be fair, they were advocating for 50 basis points in at least the next two meetings. What do you see as the appropriate path of policy in the future?
Yeah, I think that's a good benchmark for now. And, I think we're in, it's a good plan right now. I do think we need to get above neutral by the end of the year. I've been advocating just as a kind of number to put out there, or a goal of 3.5% on the policy rate by the end of the year. I think we're going to have to do more than just get to neutral. We're going to have to go above neutral in order to put downward pressure on the persistent component of this inflation. So, I think the biggest thing here is that you should probably take the big inflation number that we got today, 8+%. Some of that has a transitory component to it. I know we banned the word transitory, but part of that is going to go away naturally, and that's fine and all good for us. But there's a big chunk of it that's not in that category, is much more persistent. It's that kind of inflation that requires Fed action, and in order to get us to be able to put downward pressure on inflation, we're going to have to get the policy rate up in a range where we can put some leverage on this and move inflation down. So, we're all in the middle of this process right now, but that's my takeaway for the current position.
Could a 75 basis point move be warranted in your view? I know your remarks on the possibility of that prior to the May FOMC got markets very interested. Do you see that as a baseline need, at least in the next few meetings?
That's not my base case. So I think we've got a good plan in place, and the committee has, based on public comments anyway from my colleagues, has coalesced around a plan of 50 basis points per meeting. So I think we can proceed on that. This report was hot in terms of inflation, but not that different from what was expected coming into this report. So it's not like we got a tremendous amount of information here, although I would interpret it as indicating that inflation is broader and more persistent than many have thought.
So if you do want to get to 3.5% by the end of this year, that might be a bit of a faster pace than your colleagues. So would that imply 50 basis points for every meeting throughout the end of this year? How would you like to get there?
Yeah, I think it's more state contingent than this. So we want to take it one meeting at a time. Let's see how the data comes in. It's possible inflation could moderate a lot. It's possible the real economy could take twists and turns. And so I don't think we want to be promising today what we're going to do in December. But I think right now, I think we're on a good path near term, and then we can adjust as we go along.
So you made a speech recently where you noted that the Fed has a little bit more room on tightening if it has credible forward guidance, which implies that markets would have to read, understand exactly what it is the Fed's doing. We see the volatility happening right now, and there's also the bigger picture about whether or not the Fed is already a bit too late to inflation here. What do you see as the, audit right now of Fed credibility?
Yeah, I gave the talk at Stanford on last Friday, and I do want to press on this point that it looks like we've only moved the policy rate a little bit because we just made the one move in March and then 50 basis points last week. But actually, we've done far more than that, as you know from tracking the markets. The 2-year Treasury has moved up substantially from where it was 6 to 9 months ago. And it's really the 2-year Treasury that's indicative of where the market thinks policy is going to go. So by taking a hawkish turn last year, we've already put some of the policy restraint in place, even as I speak here. And so that's going to help us a lot to keep inflation under control. I don't think we're all the way there, but we made a good start, and we're going to get the policy rate up to a higher level expeditiously as we go forward here. We are, I am sensitive to being disruptive in financial markets, but here I think we've been very transparent about our policy. We've tried to communicate ahead of time what we're planning to do as best we can, given the information that comes in about the economy. And it is a fast-moving situation, but we're trying to be as transparent as we can. You're right. It's causing volatility right now. People are not waiting for the policy rate to get up in the 2.5% range, that all the effects are occurring right now. So that's the effect of forward guidance.
We're seeing markets right now, very volatile. It's been a very rough trading session in the past few days for investors. Do you see recession risks flashing in the financial markets? And is that going to be perhaps a Fed-induced recession as you tighten?
Yeah, I don't think recession risk is that high right now for the U.S. economy. Of course, you always face the possibility that a big shock will hit. And that has happened. And, obviously the pandemic was like that, even the global financial crisis. So you do have these kinds of possibilities. But I would say that our probability of recession is not particularly elevated at this time. And if you look at models that try to predict, recession or give you recession probabilities, they're still pretty low. There are a wide variety of models, so you could probably find one that'll tell you that the recession probability is elevated, but I don't think so right now. You've got this very strong jobs market, for instance, which doesn't at all look like the kind of thing that you'd see if you're sliding into recession.
Yeah, unemployment rate at 3.6%, still very low. I wanted to ask kind of lastly here about financial stability. The Fed had that financial stability report this week detailing the risks of stable coins. And I bring this up because the volatility that we've seen in markets has led to a lot of craziness in one specific stable coin, Luna and Terra, which was supposed to be maintaining a dollar peg. We see it has not held that level. I don't know if you've been reading up on the headlines on that front, but do you have any thoughts on the stablecoin space and whether or not that could pose perhaps a financial stability risk to the economy at this time?
I'm observing this from a distance, but I know people have been commenting on the financial stability risks associated with stablecoins. To me, they look like fixed exchange rate systems, and fixed exchange rate systems historically have not worked all that well. And so they're susceptible to attack or to loss of confidence. And apparently that's what's happening here in this particular market, but I'm a little distant from it, I admit.
Okay, but you don't think it's systemic what's happening with Terra and Luna?
It doesn't look systemic to me at this time. However, I would say that this is the kind of thing that is validating to those who have said that stable coins maybe do present some financial stability risk.
All right, well, a wide-ranging conversation right there. St. Louis Fed President James Bullard joining us here on Yahoo Finance. Thanks again for taking the time. Have a great Wednesday.
Firm's ticker page is the hottest or among the hottest on the Yahoo Finance platform today, with good reason. The stock is surging as the company's earnings quieted concerns the business could take a big hit during an economic slowdown. Affirm also said it would reach sustained profitability by mid-2023. Let's dive into the company with Affirm's CFO, Michael Linford. Michael, great to see you as always. Let's start on that profitability call out. It was front and center on that earnings release. Why did you feel the need to come out with that?
Yeah, we wanted the market to understand just how confident we were in where this business is headed. We've talked a lot about over the time the framework that we've had for profitability as being tied to the really strong unit economics that we generate and leveraging our fixed costs over time. And we wanted the market to understand just how confident we were in our growth and our ability to leverage those fixed costs.
I think a lot of folks on the street, Michael, were surprised by the gross merchandise value up 73% year over year. What component of that can you tie to Amazon?
We have not given specific numbers there, but what I would say is these results this quarter were phenomenal. This is our fifth straight beat, and you highlighted GMV as one of the measures where we grew 73%. We grew active merchants by more than 16 times year over year. Active consumers grew 137%, transactions up 162%. These growth rates are staggering. And maybe what's most interesting to us is that 80% of the transactions were repeat users. And maybe most interesting to the market is our revenue less transaction costs, the measure of unit economics, were well above our long-term range of 3 to 4% at 4.7%. And for us, this is a proof point. And what we have is different than what you see in traditional FIs or our competitors. This is a special company. And it turns out when you combine honest financial products with the world's best technology team, you can thrive in any environment.
So let's talk about the upcoming environment, Michael. It's Julie here. A firm's not been around during a recession. Certainly it has not been around in its current form, right, with the growth, the size that it is right now. What happens when economic growth slows further to not just you guys, but the buy now, pay later model more broadly?
Yeah, I can't really speak to our competitors. I think, in fact, if you look at what they've been guiding the market to, they're feeling a lot of different context than we are here at Affirm. I think for Affirm, we're confident in our ability to control all of the inputs and outputs in our business model. We talk a lot about how we can control these outcomes. This quarter demonstrates that. Look, I mean, you had one of the most volatile macro conditions possible. We have everything from war in Europe to rising rates, hyperinflation, concerns around recession, and Affirm just posted one of its best quarters. And I think there's a real insight there for investors around our ability to execute in these times. And the key insight there is, and Max and I talk a lot about this, it's our ability to decide the level of risk that we take and control it. We do transaction level underwriting, which means that we're not waiting for, we don't issue a loan out and then wait to see what happens. We get lots of small transactions that allows us to tune the results to exactly where we want them to be.
But if there is indeed an economic pullback or a recession, aren't you guys going to have to pull way back on risk, and won't that then affect profitability for the company?
Well, we will always make the right risk decision, and that's something that's been true through any economic environment. We will always think about the appropriate level of risk to take where our unit economics can be strong. Again, this quarter we posted phenomenally strong unit economics. The other thing that's really important is our business model is such that we make a lot of margin on the highest credit quality users, and we have a very steep credit curve. And that's very wonky, but the insight there is that we don't need to make major changes to our credit decisioning in order to deliver really strong unit economics, even in an environment of stress.
I suppose the other thought process around this, though, is also thinking through consumer sentiment right now. And if that continues to remain low, and if they are picking and choosing exactly where they are spending, where would you see that impact your business, either for better or for worse, if they were looking across some of the more expensive things that they tend to purchase and deciding to break up those payments over an extended period of time?
Yeah, I mean, I wouldn't bet against the American consumer. And I think what we see right now is a really robust consumer. This past quarter saw real growth in categories like travel and ticketing. We are still coming out of the COVID times, and the categories that we play in and the breadth of merchants that we have. We talked about Amazon earlier. It's Amazon, it's Shopify, it's Walmart, it's our travel business. We have a very broad set of merchants that allow us to participate in really any economic environment. We don't see any weakness with the consumer right now. And of course, we were vigilant in looking at it. But with a merchant base of 210,000 merchants, we're able to offset any sort of pressure in one spot with growth in the others.
Michael, you spent a lot of time in the tech space, back at KKR, time at HPE, now leading a firm there as CFO. Can you just talk to us about what we're seeing in the tech sector right now? Under a lot of pressure, has a bubble burst? What happens next?
Yeah, it's no doubt there's a lot of pressure out there, and you're seeing both public and private market valuations come in. For us, that's really exciting. And we mentioned this on the call. We have $3 billion in dry powder. That means that we get to be very opportunistic in looking at this market and find opportunities to inorganically grow in addition to our investments we're making organically. The reason these valuations have come in line is obviously macro driven from my perspective. That is going to continue to put pressure until we get out of the macro environment. But I'll say this, if you go back and look at 2001 and 2008, the other major market dislocations, the generational companies were the ones who could thrive in those environments, and they emerged long-term winners, and we believe that we're one of those.
So you could see yourself making some acquisitions?
Yeah, I mean, I think we are always very careful to not commit to any specific plans, but yeah, we have $3 billion in capacity here, and we need some of that to get to profitability. We communicated to the market that we need a little bit to run through this year. And then we have the balance to really be aggressive. We bought PayBright a year ago in Canada and really cemented our position as a market leader there. That business was growing tremendously well last quarter and continues to grow very fast. We know that we can do this very well. And when you can buy a business and then triple its GMV year on year, a year later, it's a pretty good proof point.
All right, we'll leave it there for now. Michael Linford, Affirm CFO, always good to see you. Have a great weekend.